From Gen Wealth Financial Advisors, it's the fastest 4 minutes in investing.
Scott Inman and John Shrewsbury on the fastest 4 minutes in investing. And we'll start with some good news related to the pandemic. Some news about COVID-19. The numbers continue, John, to go down. The United States reporting 78,000 new COVID-19 cases earlier this week, a 35% week-over-week decline. And infection rates continue to decline as well, and so do hospitalizations. And I think that's encouraging when it comes to the markets and the economy. But I think the point of today's Fastest Four is the markets and the economy were already doing a pretty darn good job of adapting before the COVID news got better.
Absolutely. The S&P 500 is the earnings on the S&P 500, the 500 largest companies in America, is tracking nearly 2% above the time of 2019 during the fourth quarter of 2019. Comparatively speaking to 2020, is 2% above where it was this time, let's say a year ago. Also, the market itself is 11% higher than it was even before the pandemic. So I think the economy has adapted. The economy has morphed. We're doing all kinds of things to get around the restrictions on COVID and what have you, and to just press on. And I think that earnings really show that is going to be the big plus coming out of this pandemic.
I think that's huge. And I think, if you got lost in those numbers when you hear them, I think it's the summary there, or the takeaway is that basically earnings are higher were higher in Q4 of 2020 than they were in Q4 of 19 before the pandemic grabbed hold of America. So yes. I think that's important to say that we're actually doing better now than we were doing before the pandemic.
Scott, I talked to Ryan Dietrich, the chief market strategist at LPL Financial, and he says they've raised their 2021 forecast for S&P earnings per share from $165 to $170 a share, and they believe that higher earnings expectations support further gains in the stock market in 2021. And that's always good news for our retired investors and people that have their long-term money in the market. It's good to know that we've come out of this to some degree with really good shape.
We always want to balance the good news with the potential bad news. And I say potential because it may not materialize as bad news, but we're always looking for headwinds, right?
Yes.
That could slow the market down. And we talked about this last week. Inflation, or the concerns over inflation, is really the most talked about potentially disruptive force in what otherwise is going to be a bull market.
Inflation still remains tame. There's around a 2.2% inflation prediction going forward. Core inflation, as measured by the CPI, the Consumer Price Index, which excludes food and energy, has averaged about 1.5% over the past 4 months. So when you think about that, from 1.5 to 2.2 is an uptick in inflation, and it does make a difference in what you're spending and how much things cost. But we don't see runaway inflation, but obviously all of the money that has come into the money supply by the Fed as a result of the pandemic has really kind of raised the ire of some of the inflation hawks and said, boy, we're really in for it. We don't think we're in for it, but we do think we're going to feel it when we go to the checkout stand.
Big key would be wage growth keeping pace with that, and hopefully the inflation is not affected in people's personal economy. But I do think that a little bit of inflation is a good thing. Runaway inflation is a bad thing.
Runaway inflation is definitely a bad thing. Good inflation really does kind of keep things humming along at a reasonable level, and it does portend maybe some wage increases in the offing.
So earnings growth up, inflation moderate or actually even tame right now. Things looking good, and that's the fastest 4 minutes in investing.